Good morning, ladies and gentlemen. Thank you to the Rwandan Bankers Association for having me, a company that specialises in last-mile payment infrastructure, and I've had the privilege of working on this paper alongside Eric Nyangira and Yves Dussembiremi. The title we've given it is deliberate, payments first. The argument I want to put to you over the next half an hour is that the next chapter of financial inclusion in Rwanda will not be won by opening more accounts. It'll be won at the payment layer, in whether people can actually transact reliably in their everyday economic lives. I'll show you the evidence for that, and I'll set out what I think this means for this room specifically. Let me start with the headline, where Rwanda is today. Here's the situation in a single slide. Rwanda has, by any international standard, won the access battle. 96% of overall financial inclusion, 92% formal inclusion. You've already passed the national strategy for transformation target of 90%. This is a genuine achievement, and it should be said plainly. But here's the complication. Availability has not become usage. Mobile payment registrations passed 20 million by 2024, and yet the active subscriber rate fell from a peak of around 67% to roughly 36%. That leaves an estimated 13 million people, registered users who are in practical terms functionally excluded, formally included on paper, but unable to transact regularly and reliably in daily economic life. We call that the access usage paradox, and the rest of this paper is about why it exists and what to do about it. The short version, the binding constraint is no longer access, it's the functionality and performance of the payment layer itself. Cash persists today, it still outperforms digital on the things that matter most for low-value, high-frequency transactions. What we propose is a sequenced payment-first strategy in 3 phases. First, stabilize everyday payments, then anchor habitual usage through wages and government flows, and only then deepen financial intermediation. And this isn't just argument, we've tested it. 52 quarters of central bank data confirm a stable, long-run relationship between transactional access and formal participation, with the system self-correcting towards equilibrium each quarter, and I'll come to that later. Let me unpack that paradox, because the shape of it tells you where to act. This chart really is the heart of the matter. The rising blue lines is formal inclusion, from 21% in 2008 to 92% in 2024. A remarkable national achievement. The line that should concern us, though, is the other one, active mobile money usage, which climbed to a peak of 67% and has since fallen back to around 36%. So the gap between those 2 lines is the story. Roughly 13 million registered users sit in that gap, dormant. They have the wallet, but they're not using it. And when usage does happen, it's episodic, clustered around salary day, transfer, cash in, cash out. 93% of users cite those as the primary activity. Everything in between, the food, the transport, the school fees, the daily informal trade, still runs on cash. And I'd like you to sit with this figure. 10% of non-users say they don't need the product. It's tempting to read that as a marketing problem. I'd argue it's the opposite. It's an honest signal that the current digital offering does not yet fit the real pattern of people's economic lives. The constraint has shifted. It's no longer access. It's functionality, acceptance, and reliability at the point of use. If that's the problem, then we have to ask whether we're even measuring the right thing. This is where I want to introduce a phrase we use throughout the paper called functional financial exclusion. It describes a population that's formally included and yet cannot transact regularly and reliably in everyday life. And one reason we don't see it clearly is that our metrics hide it. Look at the left column. That's what we measure today. Percentage of adults with accounts, the number of registered merchants, the payment rails deployed. Every one of those measures supply. It counts what's been issued or installed, regardless of whether anything actually flows through it. The right column, I'd argue, is what we should be measuring. The share of adults transacting digitally at least monthly, active merchant acceptance density, where merchants genuinely process digital payments, not just where they've enrolled, and transaction success rates and settlement predictability, the system seen from the user's side, because that's what builds the trust that becomes habit. The point I'd leave you with is that the gap isn't structural. Sorry, it is structural, not behavioral. It's not that people are reluctant or uninformed. It reflects where payments are actually accepted, how reliably they work, and how well they fit real economic activity. And the clearest proof that the gap is structural is the continued dominance of cash. So let's be honest about why cash still wins. I want to make the case for cash for a moment. Not to praise it, but to respect it, because if we don't understand why it wins, we'll keep losing to it. Cash has 4 properties that are hard to beat. It's universally accepted, every trader, every service, no technical prerequisite. It settles immediately, value moves at the moment of exchange with no confirmation uncertainty. It needs no connectivity. It works in an outage, in a dead zone, in a power cut. And it's predictable and simple. No fees, no failed transactions, no disputes. The user stays in full control. People are not choosing cash out of ignorance. They're choosing the instrument that performs. Now look at why digital stalls. First, a coordination failure in acceptance. Merchants wait for consumers to use digital. Consumers wait for merchants to accept it, and nobody moves. Second, cost and liquidity friction. Fees eat thin margins on small payments. And when an agent has no float, the money fails at exactly the wrong moment. Third, reliability and fragmentation. Network failures, delayed settlement systems that don't talk to each other. And fourth, context mismatch. Informal markets and micro-enterprises run at high frequency, low value, where even small friction is enough to send someone back to cash. So the task isn't to persuade people to abandon cash. It's to make digital outperform cash on cash's own terms. That reframing, performance, not persuasion, leads to a conceptual shift at the center of this paper. This is the intellectual pivot of the whole argument, so let me state it carefully. We're asking you to stop thinking of financial inclusion purely as a social objective and to start treating payments as national economic infrastructure, in the same category, perhaps, as transport or telecommunications. So why that comparison? Because payments do for the economy what roads do for goods. They enable exchange across every sector. They coordinate markets, they carry wages and salaries, and they're the channel through which the state interacts economically with its citizens. And like a road or a network, their value isn't defined by who runs them, who owns them, or what technology they use. It's defined by function, by whether they work or not. We define that performance through 4 attributes. Reliability. Transactions complete consistently. Acceptance, payments are recognized everywhere across every context. Interoperability, systems connect regardless of provider. And predictability, users can anticipate the outcome, the fee, and the timing. Where those four are present, digital payments become embedded in routine life. Where they're absent or uneven, people rationally revert to cash. The reason this reframing matters for policy is that it moves the conversation off access metrics and onto infrastructure performance. And it places payments squarely inside Rwanda's productivity and competitiveness agenda, not just its social one. And once you see payments as infrastructure, the next question is, who keeps that infrastructure working? Infrastructure of this kind is never delivered by one actor. It's delivered by the system coordinating. So let me put the actors on the table. The National Bank of Rwanda is the system steward, setting performance expectations, convening stakeholders, aligning incentives where collective action is needed. Commercial banks, as many of you in this room, are the anchors of settlement, liquidity, and trust, linking retail payments to the wider financial system. The mobile network operators and payment service providers drive access and innovation, reaching users and merchants that banks have historically struggled to serve. Government is the catalyst. It owns payment flows, wages, transfers, and taxes, and can reinforce acceptance at scale. And the Rwandan Bankers Association as the coordination platform that makes the dialogue and the joint investment possible. The line I'd underline in this is that fragmentation in Rwanda is not a technical failure. Interoperability already exists technically. The user experience is often uneven because of fee differences and settlement timing and transaction limits. And those are coordination problems, not engineering ones, which is good news because coordination is something that this room can actually influence. So coordination sets the conditions, but reaching the last mile, the rural trader, the smallholder, needs specific infrastructure choices, and let me show you three. This slide is the most operational of the deck, and it's where Paycode's own work sits, so I'll be concrete about it. Last mile inclusion needs three things designed for reliability, not just for reach. First, agent networks as core infrastructure. Rwanda reached 183,000 agents by 2024. That's extraordinary scale. But scale's not the same as liquidity. When an agent can't fulfill a cash out, the user doesn't experience it as one agent being short of float. They experience it as digital money failing. And that erodes trust systematically, not locally. Fragmented float management produces predictable shortfalls at peak times and in low-density areas. So agents have to be treated as infrastructure with sustained attention to liquidity, incentives, and oversight. Second, offline-capable architecture. Connectivity-dependent systems fail precisely where inclusion is hardest, among smallholders, rural traders, seasonal workers. The answer is to authorize transactions locally against a secure credential and queue them for settlement once connectivity returns. That lets you extend coverage incrementally without waiting for a full network build-out. And it's complementary to eCash. The switch handles real-time interoperability. Offline endpoints extend its reach into the gaps. Third is biometric identity through NIDA. Identity verification is the most persistent structural barrier at the last mile, and it fails hardest for those without reliable documentation and access. A fingerprint is a credential that cannot be lost, forgotten, transferred, or stolen. It uses Rwanda's existing national biometric program, no new identity instrument is required. And it removes PIN-based failures, which is the single most common transaction error for new and low literacy users. The thread through all three is the same. These are structural fixes, not behavioral ones. They make the system perform in the exact conditions where exclusion is concentrated. So that's the infrastructure. Now, how do you sequence the build? This is the spine of the strategy, and the order is the whole point. 3 phases in sequence, each a precondition for the next. Phase 1, stabilize everyday payments. Expand and stabilize merchant acceptance in informal and peri-urban markets. Strengthen agent liquidity so cash out is reliable. Improve transaction reliability and settlement predictability. Reduce friction and complexity. The success metric here is simple: frequency, continuity, and confidence in everyday usage. Phase 2, anchor habitual usage. Once acceptance and reliability are in place, you route the recurring predictable flow through the rails. Government wages, G2P, social protection transfers, and agricultural payments, crop payments, input subsidies. These create regular touch points that in turn reinforce merchant acceptance. The precondition is explicit. Acceptance and reliability must be already working. And phase 3, deepen financial intermediation. Only now do you layer the sophisticated products, cash flow-based credit scoring from transaction data, saving products tailored to observed patterns, risk mitigation tools, a shared data utility for licensed lenders. The precondition, again, usage is stable and habitual. And here's the discipline I'd ask you to hold to. Restraint is essential. Complex product innovation and advanced analytics must not run ahead of stable payment usage. Trust, coordination, and habit can't be accelerated by piling on features. If we get the order wrong, we build sophistication on sand.
Mr. Gabriel, you have about a minute left, and then we open the floor contributions.
So sequencing the build means sequencing the economics, and fees are the clearest example of that. Fee design is important. Sorry, I'm lost. Fee design is important. Making small payments cost-effective means we have to be careful about fees. There's been examples of levies put on mobile payments which had the effect of reducing usage. So fee usage is extremely important. I'm rushing through these last slides. Regulation is important. We need to review transaction limits. Over-regulation can hamper those transactions at the last mile. Regulation that's designed for large payments can often inhibit the small payments. Consumer protection standards needs to be obviously widespread, and fraud detection guidance. These are the figures that you'll find in the white paper. I'll quickly cover them. That F-statistic bounds test, what that simply means is that we've tested the data and the relationship between access and usage is a real one. It moves in coordination. The good news for the regulators is there's a very stable quarterly error correction, which means if there's a shock to the financial system, then it recovers at a predictable rate, which means the changes that you decide to make in your financial system are compounding. And internet banking elasticity, of all of the things that we tested, internet banking demonstrated that the more access that is available, the more that it's used. I think, given that I'm under pressure for time, I should probably open it up for questions.
Thank you, Mr. Gabriel. Do we have any questions, any comments? Do we have any contributions from the floor? If you could kindly give us a short intro, your name, title.
Yeah, my name is Jared Osoro. I've had a conversation with this paper, and I'll just make a few comments. I think this is a very important paper because it brings some new twist to our understanding of the divide between access and usage using empirical evidence. 3 areas that I wanted to just make you respond to. First of all is the junction between the investment that is required to make the payment really a national infrastructure, economic infrastructure, and who makes the payment among those 3 parties you say that are involved, and whether the varied incentives of those 3, the government, the private sector, and the mobile network operators who are really at the back of this will be aligned in a way that can make a transition between access to financial services and usage realizable. That's one. Second is the aspect of regulation and how regulation can actually support or impede the bridging of the access and usage gap. What aspect of regulation are we talking about here? Is it the system stability and reliability? Is it the pricing? Is it the conduct of the players? What kind of regulation are you talking about here? And finally, you talked about the shifts. You talk about the structural shift vis-a-vis what you can call behavioral shift. It's a debatable issue because some could argue that you could expect the transformational nature of digital finance to result in behavioral changes that can enhance usage of digital financial services as opposed to assuming that behavior is rigid and you need to change something else for enhanced users to happen. And finally, this is to me more of a supply side leaning argument. Are we taking into account any demand side in terms of the consumer of financial services and how the economic situation can actually be a factor in bidding enhanced usage of digital financial services? Otherwise, a fantastic paper. Thank you.
Right, that's a long question, so I'll do my best. I mean, I think the experience that we've had in working in now 10 African countries is that quite often that last mile area, the area where is often the lifeblood of an economy, there's the investment in the infrastructure that makes that work digitally is often left to the innovators and the private fintech. And that's the most difficult area for a fintech to return a profit. So I guess the central argument that I would make is that if we're going to be realistic about making digital payments work for everybody, then we need to change the way we look at that financial infrastructure piece. If you're waiting for the innovators to do it, that's not the area that they're going to focus on first. They're going to focus on areas where they can quickly demonstrate to their investors that they are a worthy business to invest in. Maybe in the long run, they will invest in that last mile. But I see it as a huge obstacle everywhere that we work, that last mile piece is often neglected or ignored or left to the private sector. And I guess the central argument of what I'm saying in the paper is, if we're serious about true financial inclusion and replacing cash, we need to have more of a focus on the areas where cash is dominant and is going to continue to be dominant unless we invest in the infrastructure that makes it work. Your second point was, I think, about regulation. And I think there's no single answer to which piece of regulation works or has the most influence. You know, as I said in the paper, that rarely is a financial system created by one operator working really well. It works because operators cooperate, which is the essence of what the Rwandan Bankers Association is doing. So a combination of the users on the ground and the regulators and the central bank and the commercial banks and the fintech need to debate and discuss what that regulation does. I mean, there's evidence. We can look at how regulation around large payments is probably inhibiting the small payments, and we need to be proportionate in the way we regulate those small payments. And I think it's not difficult for us to establish whether that's actually happening and change the rules in order to make that easier for those small payments. There is technology solutions around, you know, we no longer have to rely on having, you know, utility bills and passports and things to open an account. It is possible to open an account to the satisfaction of banks using technology. And I know because I've done that for 6 million users around Africa. And I work with central banks and commercial banks in lots of those countries. So it is possible to do that, but it does take a different interpretation of what it means to regulate those and try and not make those small farmers and rural businesses fit into the same criteria as the large businesses in the city. I think I've answered some of your questions, but perhaps not all of it. So my apologies.
Thank you very much. Indeed, a very interesting paper and showing that it's going to take us a lot of time and effort and coordination to bridge the access usage gap. My question to you is the CBDC the shortcut answer to real financial inclusion?
I wouldn't say it's a short answer. I mean, the CBDCs have a lot of potential. They're particularly difficult for offline usage. We've demonstrated tokenizing tokens as part of some work we were doing in Nigeria. As you know, that the CBDC in Nigeria hasn't gained large-scale acceptance. I think the problem that CBDCs have is people actually don't know that they need one. If I'm going to make payments in Rwanda, there's lots of options that I've got in order to make a payment, and I'm going to choose one of those. I don't necessarily understand why I would need a CBDC. So I think there's lots of value from an economy's point of view in having a CBDC. You know, from a technology point of view, if there was a CBDC running in the country, it makes all sorts of things more interesting and easier to deliver. I work a lot with UN organizations delivering social grants, the World Bank, the UN, UNHCR, people like that. We always struggle with the fiat acceptance piece. Lots of them are now exploring stablecoins. Stablecoins have won the battle of being a great transport layer, but I don't accept that they're a good store of value, and they bypass the banking infrastructure, which I think creates all sorts of problems. So I'm one of the few people that's standing up at these conferences and saying, stablecoins are not the way to go. Tokenized value or CBDCs might be the way to go, but they struggle with connectivity. We can tokenize a token, but central banks don't like contingent liabilities floating around in some token atmosphere that are going to come back for settlement at some point. There are technical answers to the question that you raise, and I think CBDCs are important. They struggle with this reputation they have at the moment that they're a solution looking for a problem.
Thanks, Gabriel. You mentioned that payments do, to to the economy what roads do to goods. And I want to bring those two together because roads are built by governments. There's a cost of infrastructure, cost of technology that is changing rapidly. Currently, we do have a case in point. Policymakers thinking there should be a zero tariff on payments for it to work. The actors, telcos, banks, everybody in the financial system obviously incurs a cost in delivering the innovations. What would be the best way of funding in payments public infrastructure? Because, and I say this for the fintechs that are innovating to bring the new technologies, how do they recoup their money? Do they get locked out of the ecosystem? How do they survive? What would be your views to balance between affordability, but also not making it difficult for anybody to undertake any innovations?
Yeah, that's a good question. And there was actually a slide on fees, but given the shortness of time, I wasn't able to deliver it. I think it's important. I don't think there's an alternative to government intervention in laying out the infrastructure. That's why I compare it to roads. I think if you're waiting for it to happen organically, you'll probably be waiting for a long time. So I think there's an intervention necessary, but I don't think that that means that the burden of funding the system should fall on the government. I think there are ways, in principle, the low value, high frequency payments, I think need to be as close to free as possible in order to get that large group of people to accept digital payments as part of everyday life. Because it's only then when we start them on that journey that we're able to layer on those more sophisticated products. So I think that the payments at a business payment level and remittance, for example, should be used to fund those low-level, small payments at the rural level. Because I think it's, once you start down that road, and once we get to that third phase that I talked about, where we're actually getting business data, if I can see as a commercial bank that, the credit worthiness of somebody because of the transactions that they've been doing, all of that data becomes valuable in itself. But I think there needs to be a catalyst to start us down that road. And ultimately, the banks in the room, they're interested in growing their balance sheets and being able to deliver more sophisticated products to those customers that we're kicking off now. So there needs to be a catalyst, but ultimately, if the system isn't self-funding, then it will fail.
Okay, I think because of time, we're going to take one more contribution.
I've seen it, I've discovered it. Thank you, Gabriel. I think this is a very deep and good study. And I think I agree with you on two things. Number one is what the chairman mentioned about how to treat payments infrastructure. I do believe that the payments infrastructure initially should be treated as a public good. So governments and central banks should come in strongly to set it up. The economics, how it goes after that, can always be dealt with, just the way we deal with the road toll and stuff like that. But the initial investment should always have a very strong government involvement and be treated as a public good. Number two is about the stablecoins. I think we shall discuss that later, because stablecoins also bring in another dimension in the economies of Africa, or anywhere in the world. They bypass the infrastructure of the setup of the whole banking system and financial system, and can cause other repercussions in terms of monetary policy transmission, definitely. So we can't go that way. But for CBDCs, I believe that they stand between physical cash, fiat money, and digital money. So central banks must also study this very carefully to see how that CBDCs can ride on the existing mechanisms and be able to transmit monetary policy. And I think that's where that's where the glitch comes in, and that's why they cannot be connected for now. However, if we study it very well, we can use CBDCs to actually lower the cost of transactions, but also have a well-structured monetary policy transmission mechanism. Thank you.
I agree, and I'm glad you agree with my point on infrastructure. I think that's exactly the right approach. It needs to be a catalyst, needs to be the government to make sure that that infrastructure is in place. But I recognise that it's not maybe politically palatable to expect the government to completely fund that going forward. But I believe there's a self-funding mechanism that's there to be discovered. And CBDCs, I'm a huge supporter of CBDCs, less so of stable coins. And I think that there's value in a government investing in a CBDC. In some countries that are working, I don't think that's going to be a simple answer. I think Rwanda's probably a different case. It's not the response to people using stable coins, well, let's have a CBDC, then they will automatically use that. Payments and money generally is built on trust. And if people don't trust the institution, then they won't use it. And lots of the countries that we're working in where they're building CBDCs, I'm concerned that ultimately the citizens don't trust the bank and therefore they won't use it anyway, even if it's free. But generally, I think the CBDCs are an important part of either tokenizing real value, tokenizing the money that you have on your balance sheets, or a CBDC is the important next step to fight the dollarization that is being forced on everybody by stablecoins. Anyway, I thank you for your time and attention, and I appreciate, again, the invitation to be able to present the paper to you today. Thank you.